It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Sitting in with me, the mayor, the governor of the great state of Texas, the guy who owns more real estate than anybody that I know, Mr. Michael Becker. How are you?
Hey, Paul, that's probably not true. You know some guys that own more apartments than me.
Maybe, but you are the governor himself, so of the great state of Texas. There's so many apartment units that they were thinking about changing one of the towns to Beckerville, USA. Beckerville, USA. I like that one. So, Mr. Michael Becker, as you know, Michael has been a longtime banker, commercial real estate banker. He led his division a number of years ago doing commercial real estate lending, and he has taken that loaning money to owning real estate. And so he's done a great job, and we're fortunate to have him into the podcast. We learn a whole heck of a lot of information with Michael. As you know, SPI and their group, they've done over $1 billion. Yes, with a B, $1 billion in apartment transactions. They have closed over 38 apartment buildings, and have owned up to 8,000 apartment units. So Michael certainly knows what the heck he's doing. And so we're pleased to have him in the podcast. Two things I want to do before I ask Michael the question is, don't forget to see, we're trying to get 1,000 5-star reviews on the iTunes. So we'd appreciate if you ever had a chance to get back onto the iTunes and leave us a good 5-star rating. If you thought or we bring any value to your life when it comes to multifamily information, we would appreciate it if you could do it. And the second thing is a report that Michael and I and James Eng wrote, and we continue to update it on Multifamily Financing 101. Multifamily Financing 101. And if you are trying to buy an apartment building or be an investor in an apartment building, you should know what the rules are. So we put together kind of a white paper report of what you need to know when investing in apartment buildings, of structuring the financing. We bring 75-80% of all the money to the table. We should be your best friend. So know how to treat your best friend. It's really how to make your best friend be more of a better friend to you. So kind of a white paper report. Go to oldcapitalpodcast.com, oldcapitalpodcast.com, download that multi-page report. And then Michael has also written, and he uses this himself, is his due diligence checklist. Michael, can you tell us a little bit about what that due diligence checklist is all about?
Yeah, it's when we make letters of intent or even put in the purchase sale agreement of the contract. When you buy these deals, you get a list of all this diligence information that the seller provides the buyer. And so this is kind of the sample list. This is kind of like everything that we would in a perfect world want to have. So it's numerous items, and then so we attach that to the LOIs that we send out. So if you guys are newer in the business and you want to get a quick shortcut on how what information you should be asking for, this is a literal document that we use on all our LOIs and what we try to get. So I would recommend just plagiarizing what I do.
Yeah, just download it, cut and paste, and I think that's pretty damn easy.
Change the logo, though, please. So.
You don't want to be buying a property in New Jersey, Mike?
That's right.
So in the question for Ask Mike Mondays, which I think is a pretty simple one, Mike, on an acquisition, have you ever had a seller be the lender? So have you ever had the seller carry back the note or done subordinate financing? We have not.
I mean, I think that obviously happens. I don't think it happens in markets like this. I think it might be more relevant in tougher markets because right now the debt and equity markets are robust and alive. So there's numerous options right now. But sometimes if it's a tougher environment and the seller wants to kind of sell the deal so bad, he wants to make it so attractive, maybe they'll carry back the note or maybe, like you said, a second behind the lender so the lender can have a lower leverage loan.
Have you seen that in any of the markets that you guys are in or any of the transactions you've lent on in the past?
I haven't heard of that in years, right? I mean, I think maybe during the recession, that was something that was sort of around from time to time, where the seller would carry back $1 million behind that, or my client would say, "Hey, can you give me a $3 million loan?" and have the seller carry back $500,000 or $1 million behind it in a second. We've seen that back in the day. I think it's more prevalent, Paul, like on older, smaller kind of properties, a little bit more mom and pop. I mean, these 200, 300, 400 unit apartment complexes. I don't really see that or I don't recall seeing that, and certainly not in today's environment. But back 10 years ago in the bad old days, that probably was a little bit more common.
Certainly, you don't see that so much today, there has to be kind of a reason why the seller wants to carry the property back. And especially with financing today, I'm not going to say it's loosey-goosey, but it's pretty open for banks to carry back the loan on property. If that property is performing, there has to be something maybe financially wrong with that property, whether it's the financial statements that the seller's providing you just do not make sense at all, and then maybe the bank cannot finance it because the numbers don't make sense.
Yeah, and I've seen some banks like maybe have a A and a B piece, meaning they'll have like a first mortgage at 4% or whatever the prevailing rate is today, and then they'll strip in like a mezz piece behind it, so they'll do like a first loan and a second loan. And the mezzanine financing that's kind of in the second position might be at like 8% or 9% or something higher. So they'll do, maybe 65% of leverage at 4% and 10% leverage behind it, up to a total of 75 or 80 or something like that at some higher rate. So that's out there, and that's relatively common. But
you confused the hell out of me, so I got to understand this. Now, what is mezz debt? I don't understand.
Yeah, so mezzanine debt is effectively kind of like quasi-equity, right? It's in a subordinate position to the first debt. So it'll be, like I said, like maybe it's the same lender, maybe it's different lenders, but they'll kind of think of it like an A piece and a B piece. So like the A piece is in the first position, and it would be like a regular mortgage where a bank will give you, maybe 65% or 70% loan to cost. And that's like a normal leverage deal. And certain people want to kind of juice up the leverage to make the deal economics look a little better on paper without raising capital. So then they'll put a mezzanine loan on it behind it, or some people put preferred equity in there, kind of function very similar. Those tend to have higher rates. So sometimes I could say maybe be 10%. So the first position up to 65% would be at, say, a 4% interest rate. And then if you go from 65 to 80 leverage, that 15% B piece or second lien might be at 10%, Paul. And sometimes that's all current. So you got to pay all 10% current. And then sometimes it's a 10% rate where you pay 5% current and 5% accrues, something like that. So it could get a little bit more exotic than kind of the bread and butter stuff most people do.
But we're not usually seeing that on $1 million or $2 or $3 million property. That's like a 10, 15, 25.
Larger.
Yeah, much larger properties. Then you start to become pretty creative.
And then sticking that in, obviously, it certainly has the potential to amping the returns up for the investors. So there's like because
you're creating more leverage into the deal, where the first bank, let's say the A piece, did not want to go with full leverage. They felt comfortable at 65. But somebody came in at the high, to go to the higher leverage between, say, 65.1 all the way up to 75 or so, 80%, whatever. Now, remember that in lending, that second piece, that B piece, if you were to default to keep that B piece around, the B piece would have to put the first lien into foreclosure position to keep their B piece position. So there's a lot more risk in those deals for the B piece in case you default. Other piece
and the investors behind it too.
Right. And and the other piece of the puzzle too is that making sure the overall debt coverage ratio makes sense, because these buildings, you just don't want to put a large amount of leverage into them because the cash flow sometimes cannot cover it. There's just not enough income coming in, and we don't want to ask the borrower personally to write a check every month to keep pushing money in. But if the debt service is too large and the income coming in does not cover it, whether you put it at 65 or 70 or 80%, there's just not enough income on the property, at least right now, to get up there. So a little confusing, but also too, one of the things that I think I want to throw out, there's really two things. One is that Fannie Mae and Freddie Mac are not going to allow you to put a second lien against the property from somebody else. So if you have a Fannie Mae loan and you have a first lien of, say, 70% or 75%, whatever you took out initially, and then within the first, say, year or so, then you've got better NOI, better numbers on the property. Now you want to come back and take a second bite of the apple by pulling some cash out of the property. You cannot walk down to your local bank and put a second lien against the property if you have your first lien with Fannie Mae. You just can't do it. So you have to go back to the seller servicer, the DUS lender. Let's say, I'm going to make this up. Let's say that it is Arbor as an example. Arbor is the DUS lender. You got to go back to Arbor to get the second lien of the property. They're just not going to allow anybody else to service the loan except for the first lien lender. So again, you cannot have a second lien from the property from a local bank. It says in your loan documents you can't do it. If you try to do it, or you carry money back in a sale that you carried the loan back, and put it in as a silent second or so, you are violating the terms of your contract that you made with Fannie Mae. So that's a bad boy clause. Don't be a bad boy or girl. Don't do it. But talking about agencies, and let's kind of go maybe the second part of the question is, you guys just recently had something go on with Freddie Mac, and can you tell me a little bit more about that and kind of define what the heck all that stuff means?
Yeah, so we had we bought a 2-property portfolio with our partner Barry out in Tyler, Texas. It was about this time last year when we were in escrow. And so as part of it, we were kind of debating and going back and forth. So Fannie Mae doesn't like Tyler because it's got too much exposure out in Tyler, so they're kind of pulled back. So Freddie Mac really is the main or the agency that's lending out in Tyler, Texas, which is, a secondary market about an hour 45 east of Dallas, something like that.
Again, why doesn't Fannie Mae like it out there?
Because it's a relatively small market. So the metropolitan Tyler is like 200,000 people, and the city itself, I think it's like 120 or something like that, Paul. So it's a relatively small market, and they've lent on so many apartment buildings out there that have so much exposure, they didn't want to do more and more exposure. Yep. Or if they did do it, they were going to do it at lower leverage, and so basically this gets put in what Fannie Mae calls pre-review. So they're just more conservative, and Freddie Mac doesn't have the same level of exposure. So they are, so it's Freddie Mac, CMBS, or like a bank loan would probably be kind of the most of the liquidity in that marketplace comes from one of those sources. So anyways, I went back and looked at it because we were just working on this yesterday in October of last year. If you guys recall, the 10-year Treasury was climbing. The Fed was raising the overnight rate, quarter point. I think they raised it 4 times in 2018. So we actually ended up rate locking, or what Freddie Mac calls index locking. So you kind of lock your index, which we were going to do a 10-year loan. And they locked it at, I think it was 316, which is what we index locked at. And then about a week or two later, after we were index locked and we're in a contract, the seller comes back to us and says, "Oh, hey guys, by the way, I'm locked out of my loan. I cannot prepay my loan until July of next year."
Wait. Let's back this up. And so when you index lock, do you have to pay a cost?
We posted. Since we're Freddie Mac Select sponsors, we only had to post 1% good faith deposit. So it was a $9.6 million loan, if I remember. So we posted $96,000 as collateral. Usually it's 2%.
So when you posted, you actually write a check or wire money
into the lender, and they hold your feet to the fire until you close.
Okay.
And so we had about $100,000 up to index lock.
Wow.
Yeah.
So you put $100,000 to keep the interest rate locked, to keep that money available till the time that you go to close.
Yeah, we're going to close in December, I think.
Okay. Then you hear back after you've done this from the seller, and the seller says, "Guys, sorry about this, but we just found out that we cannot sell you this property outright."
That's right. So they had a CMBS loan on it, and they didn't pay attention. They thought they had a 1-year lockout.
CMBS stands for what again?
Commercial mortgage-backed security. So it's a securitized loan that.
So it's not a Fannie or Freddie loan. It's a kind of a different loan program.
Yeah, and then so they had a 2-year lockout, meaning they cannot pay off that loan for the first 2 years that it's in existence. So
that would certainly have been good information before you spent the $90,000.
That would have. So they can, they're a good group, came back hat in hand. So we ended up getting a pretty substantial credit against the purchase price. And we pivoted and actually did the loan assumption. So they gave us, almost $1 million off the purchase price. We assumed their mortgage. Well, Freddie Mac's been this entire time, so we're a little bit over a year after this kind of came to light. They've been kind of holding the index lock for us, and they're come knocking on our door saying, "Hey, we got to settle this index lock somehow, some way." So they've actually come back. We've done a pretty good job. Our NOI's up through doing some renovations and just better operations of the property since we've owned it. So they actually ended up increasing the loan proceeds from what they originally quoted us, about $1 million, give or take. And they actually lowered their spread, which would then effectively lower our rate. I mean, even though
this is you've promised to do a loan with us. You've given us $90,000 now. We'll wait our time,
So basically they come back and they're sweetening the deal because the Treasury is materially down from that point last year, and then 2, our operations are doing a little bit better. So they're going to give us a little bit more interest only, a little bit more loan proceeds, and they're going to take some out of the spread so the rate comes down. So our option is really option A: go ahead, process the refi, or B, they're going to make us defease the loan, the index lock essentially. So it's basically you could get over $1 million more out, or you have to pay me $1 million in defeasance cost.
I'll get the $1 million more out.
So that was a pretty easy decision at the end of the day. But it's just kind of interesting that ever since Paul had another client that had that on a Fannie Mae loan, and I'm not quite sure if they had the seller just didn't sell it, so they defaulted. But making sure, that's one of the checklist things that I always ask the broker before I sign a contract is like, are we sure? Because the seller can double confirm that they could pay their current mortgage off. Because this, you never really think that this would happen to you. You think the seller understood it. This is a really sophisticated seller that owns, tens and tens of thousands of units. So they just kind of, got lost to the shuffle. So even big organizations with a lot of history can make little mistakes
big organizations like that, or small mom and pops, everyone can make a mistake on that. And so we've had that same scenario where the seller has come back after we've locked the interest rate, we've drawn the loan documents. The loan documents are at the title company, and the escrow company has been asked to get the payoff. And the lenders come back and said, hey, listen, you guys can't pay this loan off because you're in a lockout, which means that we cannot accept those funds during this period of time until the lockbox or lock off gets removed. So we've had to scramble to do it. So it doesn't make a difference if you're a big organization or a small organization. Those things can happen. And what's good about Mike, the seller on that one was good to deal with. On one of our podcasts we had, the seller wasn't good to deal with, and eventually had to get sued. And that was, I think, 3 years ago, and they're still in litigation on that deal. And so those things do happen, but always ask your listing agent once, twice, or 3 times to make sure that the seller has the right to pay off this loan and you're able to buy the property outright. Anything more, Michael?
No, yeah, just the things on the ever-growing checklist to not do again, and then kind of like the things that we try to check on it gets ever longer because little weird things can happen from time to time. So just make sure you do your best to pay attention and try to take as much risk out along the way.
Michael has gotten some great knowledge over a period of time. As you have heard in the past, he has closed over $1 billion in multifamily properties with SPI Advisory. If somebody wanted to get to know you guys a little bit better and a little bit about what you do and how to be get on your team, what's the best?
The easiest way to find out information about us is simply go to our website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form. Fill that out, and I'm always happy to have a 10 or 15-minute call with listeners that meet out the podcast if they're potentially interested in investing with us.
Some great information from Michael Becker, Mayor, Governor of Beckerville, USA. We certainly appreciate him being in the podcast. Again, I'm Paul Peebles. Have a great day.